Hello there, this is Hector. Welcome to my Forex trading course. Over the following chapters and the following videos, I'm going to be explaining in detail my trading system, okay? All the different tools and trading strategies I use in order to, trade for a living full time, and how you can also absorb and adapt those techniques, those strategies into your own trading. Okay, I don't want to get ahead of myself. In this first chapter, I only going to be talking about how to spot valid trading opportunities, how to seize those opportunities, and filter out the high probability trades, the high probability setups, and discard all the rest. Okay. In this first video, I'm going to be laying out in detail how I personally spot trending scenarios, okay, how I spot the trend, how I qualify the trend. You know, different traders use different techniques. Some of them use the ADX indicator. Some others use actual trend lines. I myself prefer to rely on actual moving averages. And the reason as of why I prefer moving averages over trend lines is because trend lines usually leave too many loose ends. For example, in this chart you are seeing right now on my live screen, which as you can see is the American dollar against the Canadian dollar on the 4 hours time frame. You can always draw a number of trend lines in your chart. Clearly the trend starts here, and we can firstly draw that trend line, that first trend line. As we can see, it gets breached there and then there, so therefore we can draw yet a new trend line, which it holds in place there, and then it's retested and holds once again there, but then it gets breached there. Okay, so you may be thinking, all right, this trend is finished, now we are heading up. But as you can see, we are actually afterwards, price continues to go down. Therefore, we can draw yet another third trend line, okay, right there, which once again, it holds price there, and finally there, but then it gets breached there once again, and it seems like it's turning around yet again. So that's my problem with trend lines. There are too many loose ends, too many possible readings on that trend, and I usually find moving averages to be more reliable, okay, more stable as per where the trend is going. Okay. I use 3 moving averages as far as spotting the trend. That's the 30 simple moving average of the close, the 50 simple moving average of the close, and the 100 simple moving average of the close. Okay, I usually plot the 30 in green, then the 50 in red, and the 100 in blue. Okay. Now, once I have those 3 moving averages plotted on my chart, I search for 6 particular conditions to apply, okay, to be in place, all of them at the same time, before I can safely label a trend as, let's say, healthy or stable. Okay, now I'm gonna be listing all those 6 conditions to you, and I'm gonna be explaining the logic behind. Okay. Alright, the first condition is that all the 3 simple moving averages are in order. Okay, as you can see, in this case we have the 30 moving average below the 50 and the 50 below the 100. Okay, that means that the first condition is fulfilled, and therefore we are possibly, if all the other conditions apply, we are possibly looking into a solid downtrend. Okay. Moreover, the second condition is that all the moving averages are pointing in the same direction. Okay, as we can see, all the different moving averages, the 30, the 50, and the 100, they are all pointing down in the same direction. Okay, we don't have, we could have the 30, the 50, and the 100 all in order, but the 30 already curling up and beginning to point up. Okay, that would mean that this trend is weakening, is endangered, or at least for the time being, is not as strong as I would like it to be, okay, in order to search for trading opportunities. All the way along on this USD against the Canadian dollar 4 hours chart, we can see that all along the moving averages have been in order and always pointing in the same direction, okay, so those two conditions are certainly in place. The third condition is that all the three moving averages are parallel to each other, or if you prefer, that there are no crossovers, okay? And once again, as we can see, well, there are no crossover whatsoever in the screen, all right? On those moving averages, they are all of them parallel to each other, or like I say, no crossover whatsoever. Always the 30 moving average remains below the 50, and the 50 always below the 100. Always parallel to each other, always pointing in the same direction, and no crossover whatsoever. So far, so good. We are certainly, for the time being, we are certainly downtrending. Now, the fourth condition is that price remains on the right side of the 50 simple moving average most of the time, okay? Remember that the 50 simple moving average is the one in red, and what I like to see is price on the right side of the 50. That means that if we are looking into a downtrend, I like price to remain below the 50 simple moving average most of the time, okay, and it's been so. I mean, it's been below the 50 for quite a while. A little pierce above is okay, as long as it dives back down immediately. At the end of the day, the markets are not perfect, okay? The markets, you cannot expect price to behave the way we like it to behave all the time. So in a trend, sometimes on a pullback, okay, we might see price breaching above the 50 for just 1-2 bars, and immediately after diving back down. Like I say, as long as that breach above doesn't take more than 1, 2, 3 bars maximum, within 1, 2 or 3 bars, price dives back down into the right side of the 50 simple moving average, we can safely say that the trend is still in place, all right? Basically what we want is the 50 simple moving average holding price on the right end of the trend, meaning below, in this case, since we are in a downtrend, below the 50. Now, the fifth condition is that the 100 simple moving average has never been breached, okay? In my opinion, this is an important condition. I want the 100 moving average to never been touched, okay, never been violated, and price being nowhere near it, in fact, okay? Just as I said that just as I said before, then it's okay to have a quick touch above the 50, as long as price dives back down, immediately after. I like price to be nowhere near the 100, okay? Any single touch, even if it's just for 1 bar, I consider the trend to be jeopardized. And the reason for that is that, well, we all know that as price trends in one direction, we go through 2 different stages, okay? One is the thrust, the swing in the direction of the trend, and then we usually see a little bit of a pullback, then another thrust, then another pullback, another thrust, pullback, okay? Most of the trends are shaped up in that way, okay? A swing in the direction of the trend, a little bit of a pullback, which is never as long as the previous swing in the direction of the moving averages. Then after the pullback, once the pullback has been finished, we take off yet in another swing in the direction of the moving averages, then yet another pullback, which is never quite as long as the actual previous swing, okay, never quite as long, and then another swing, etc., etc. Well, in this trend, as I was just showing you guys, well, we basically go through swing, pullback, swing, pullback, swing, pullbacks, and so on. In order to, in most of the trends, in order for price to touch the 100, usually what we see is is quite a large pullback. Okay, let's assume, for example, this last swing I'm marking right now in my screen, and it's followed by this pullback. If we were to reach the 100 simple moving average, that means that the pullback would have been, in most of the cases, quite as long or almost as long as the previous thrust, as the previous swing in the direction of the trend. Okay, and that's not a healthy indication. Okay, that's never good to say. You always want the impulse part of the swing to be much larger than the retracement part. Okay, you have a nice long thrust in the direction of the trend, and yeah, small pullbacks are all right. If we were to reach the 100, as you can see, the pullback would have been way too deep. Okay, the pullback would take quite a long bite, quite a deep bite into the trend, and that usually is a signal, an early indication that the trend is actually weakening down. Okay, so that's why the fifth condition of my system, as far as spotting trends, healthy trends, I mean, is that the price is never gets never around the 100 moving averages. Okay, so far we have all of them pointing the same direction, all of them parallel, no crossover, all the moving averages in order, price remaining on the right side of the 50, and nowhere, even if it's just for 1 second, we might breach a little bit above the 50, but never to the point to get around the in the nearabouts of the 100. Okay, and finally, the last condition, the sixth condition, is that price swings harmonically off the area between the 30 and the 50 simple moving average. All right, that's what I call myself the dynamic area of support and resistance. Well, in this case, resistance, since we are in the downtrend. Okay, I usually mark the area between the 30 and the 50 simple moving average as a dynamic area of resistance. I like all the swings to take off around from this area. Okay, I like the for example, price retraces back to this area. This dynamic area of resistance holds the price below, and from there a whole new swing takes off in the direction of the trend. Okay, then sure, we may have another pullback, but I like to see once again the moving averages, the 30 and the 50 simple moving average, or rather the area in between, the dynamic area of resistance, to hold the price below, to indeed work as resistance, and from there price to take